Federal Reserve rate hikes will keep Americans from playing the lottery.
So as the Fed raises rates, people will not play lottery games.
Fewer people will play these fun tickets, I don't know.
Scratch cards.
As the Fed increases rates. Let's get into it. Welcome to the knock-on effect, where we start with the thing you know and end up in a strange place. And joining me today is my Scratch co-host, Justine and Roger.
Thank you.
And the man with all the winning numbers, my blonde across the pond, the professor himself, Roger Hurst.
Thank you very much, and good day.
And it looks like today, Professor, you're playing some scratch-offs, Top Dog and Fat Cat.
I always try to look my best for these sorts of random events.
Well, it's funny because it all is kind of one unified
He looks
theme.
a bit like the top dog, I must say.
Not
the face. The face is different. So after today's main segment, our top dog here will solve a mystery about Tesla shares, and remind us about something that happened to another car company in the past, and that should be very interesting. But first, Justine, Roger, and I are going to try to get you from rate hike to these lottery tickets here. And your job is to figure out where we're going before we do get there.
Okay.
So with that in mind, I'll let you hazard a guess if you want to take a crack at it.
Okay, so Fed is raising rates. We know that's been happening. As rates go higher, people are going to go into things like bonds because bonds will have much higher yield. So people will go into more safe assets away from things that are risky. And so the lottery, I don't need to gamble my winnings away at the lottery. I can go and invest my money in the bonds market.
It's hard to make mega millions in the bond market with a small amount, with $2 like I paid for this ticket. But,
oh my God.
But Roger, how would you grade that guess?
That was damn good. Very, very logical.
Thank you.
Very logical. In fact, that would probably be the sort of logical answer you'd expect. But this is the knock-on effect. It's far more convoluted, so therefore you're still in the bees.
Okay.
That's right. That's a good guess, though. You are mistaken, but we're going to start with just give a little refresher about what you do know, and our viewers probably know as well, which is that the Fed raised their key target rate, the Fed funds rate, they were trying to keep that in a range between 1.5 and 1.75%. And now they're trying to keep it in a range between 1.75 and 2%. Roger, why would they do such a thing?
Well, they're normalizing rates, and we've been seeing this for quite a while now, over a couple of years. Because obviously we had that record period where interest rates were at zero. But as unemployment is low, getting sort of sub 4%, wages are edging higher, and some other forms of inflation are picking up as well, that there is this worry that, with all this central bank liquidity sloshing around the system, as you start to see growth and inflation start to pick up, you could suddenly see an acceleration in inflation. So the Fed is raising rates to really put a lid on that and to really just keep up with the economy.
And I do want to stress, even this 1.75 level is still absurdly low, especially for where we are in the business cycle. Like the economy is booming, like everything's going well. We haven't seen the wage growth that we wanted to, but still for where we are at this point, rates are insanely low.
Yeah, and unemployment is very low too.
Yes, so 3.8%, I believe, around there.
Which is really crazy. It's like World War II.
Well, you also, I don't want to take this too off track, but you do have a drop in the labor force participation rate. So we have all these factors kind of coming together.
Well, a lot of people are retiring.
Yeah.
I don't want this is like becoming our debate segment again.
Yeah, right.
So that Fed funds rate, though, just getting back on track, if I may, Justine, it doesn't just impact the banks who keep their money overnight with the Fed. It's the reason it's the benchmark rate is because it's important for so many things in our economy. And Roger, maybe you could just give us a little refresher on why we talk about the Fed funds rate so much.
I think you said it in the last sentence. It's the benchmark rate. So this is the rate from which pretty much all financing products are set. So when the Fed raises rates, it gives all the banks and finance institutions an opportunity to nick a few more basis points, make some money, and raise the cost of borrowing money and of loans. And it's across all products, whether it be from student loans, auto loans, credit cards. You could even say on housing as well, though mortgages are nearly always set off the longer end of the curve. Yes, it's going to impact pretty much the whole gamut of financing instruments. So there is definitely a problem in a world where, in the US, total debt is at record levels. These rates going up is going to have an impact on the repayment costs of these debts that are out there.
Yeah, I love a good gamut myself. So it's those auto loans here that I am going to focus on.
Yes.
So those are a big deal. There are more than 100 million auto loans outstanding in America. I believe that's a record. And it's a number that's only been on the rise. Also, the size of those loans, not surprising given the price of everything is gradually increasing, it is also on the rise. So the average new loan is above $31,000 according to Experian.
And that's key because actually car prices have been increasing. So
That's
even
right.
though, they're adding all sorts of TVs and GPS systems and all these new things into these cars. And so car prices are increasing. And so the average loan price has also been climbing up.
Yeah, and so the average rate for these loans, according to Experian, is 5.2%. Seems rather moderate to me. That sounds pretty good. But naturally, as these rates rise, it's not good for the auto market. So interest rate concerns have risen to number 6, risen sharply to the number 6 biggest worry.
Of people.
Of car dealers about
Oh.
things that are keeping their business back. Number 1 is market conditions. And number 8, this is kind of a sidetrack, but number 8 is consumer transparency and pricing.
What is consumer transparency and pricing?
In other words, now you can go on the internet, find out how much other people are actually buying for these cars, and they can't say, I'm giving you a great deal.
So the more liquid this market is, or the more transparent this market is, the worse off it is for them.
For the dealers, isn't that funny? But getting back to the rates here, so this is Cox analysts explaining that the 1% increase on the average auto loan we've already seen, this is before the most recent rate hike, has increased the average monthly payment by $14. They're on higher vehicle prices. Average payments are up 4% from last year. And it's also interesting that it gets tougher for dealers to offer those incentives like zero money down for the first 6 months or zero APR for the first year.
Yeah.
Bottom line, quote, the automobile industry is cash intensive. Rising interest rates impact all corners of the business. I think we've flogged that horse enough, and I've convinced you that declining demand for new cars will result. So that's the next effect.
Okay. I see.
So the problem with this is that it's still kind of important to get from one place to another.
Transportation is an important part of life.
And this is where technology comes in. So here's a quote from Dan Yergin, who's a economic historian, energy expert. I found this very interesting.
He wrote the prize.
This prize?
Not that prize.
He underwrote the lottery prize? That's really impressive.
No, he wrote this
I
wonderful
knew he was
book.
doing well, but like...
No. He wrote this
right.
wonderful book called The Prize. I highly recommend it as reading.
Okay, very good. You heard it here first? I don't know. So anyway, he says, a great automotive paradox where more travel via car than ever, but fewer cars will be needed by individuals, will be a defining quality of the new automotive future, and the shift is just beginning. And the new buzzword, or buzz acronym around these changes is MaaS.
Huh.
This is not the knock and effect.
Mobility as a service? Oh, did I guess that?
See, that's really disappointing. I was hoping you'd say something really dumb.
Holy moly,
but
I
you nailed
guessed it.
Yeah. Roger, that's actually pretty impressive.
Yeah, grades are going up already. I think it's very good. So it's an A to lose now.
Oh, no.
So this mobility as a service, it's a new way of thinking about transportation. So instead of a car being something you have that you use to get from one place to another, just like a house is a thing you have that you watch TV in after work or whatever, we're thinking of the transportation itself as the key. So solving the problem of how do I get from one place to another, rather than, okay, let me get a car so I can get from one place to another.
It's funny. I really thought we were going to go into like auto loan default rates and stuff like that, but we totally went in this other direction.
Yeah, by the way, there's an interesting trade idea about that from Maxwell for Real Vision subscribers. Throw in a little plug there, why not?
Oh, this is the GM trade?
Yeah, because it's all about the auto defaults, and he also did an X review on it. Anyway, it's an interesting thesis. We're not going there. We're going to the future of transportation.
Sure.
It's actually a totally discrete way of thinking about the world. And we're already seeing it happen. This is Zipcar. This is Uber or Lyft or Juno or whatever you use. I use Lyft personally. Anyway.
Me too.
You do?
Yeah.
Juno's pretty good though.
I've never used it. There's also Via. We can throw them all out there.
Why not? There's probably some others that they use in the UK. What do you use, Roger? What's big over there?
There's only really Uber over here, or the good old-fashioned London cabs. But they're not. They're the old world, and I like that.
There you go. That makes sense. So anyway, and Zipcar is another way of doing this. It's the service of, here's a car, you can use it to get from one place to another. And in terms of the cultural angle, people have moved to LA, they say, you moved to LA, you have to get a car. Now people are moving to LA, they say, all you need is a credit card and a smartphone. Just get from here to there via Uber.
Right, you don't actually need to own your own car anymore.
Yeah.
I know from my perspective, I definitely would prefer to rent a car. I mean, I would prefer to rent pretty much everything.
So this is happening anyway, this shift toward mobility as a service, but on the margins, I sometimes feel like the show should be called On the Margins, but on the margins, these higher prices to buy a car are going to increase the amount of people who think I can just get rides instead.
Yeah.
So that's our next knock-on effect, that these car alternatives are gaining ground. And with that out of the way, would you like to take this is your final chance to guess how we get to lottery tickets?
These scratch-offs.
Scratch-offs, Mega Millions. So on.
Oh yeah. People are going to be doing a lot more of these car sharing services.
Okay.
And so they're going to not need to have a lot of money to make a gigantic purchase for a car, and so they won't need to play the lottery. I feel like I'm going downhill.
It's okay. It's all right. I think you're firmly in the B territory. So, as basically, here's where I'm going with this. As the moss grows, you could say, always on the sunny side of the path. A whole suite of services, a whole suite of services are going to grow up around it. And I'm going to talk about a specific company called Stratum, rather gloriously named, which was recently acquired by a car auction and salvage company. And what Stratum does is really interesting. Their motto is powering fleet operations. And they're in the business of providing services to companies that are themselves providing mobility as a services. I'll give you an example of what they're doing.
It's like a derivative of a derivative.
Yeah, exactly. It's like a long VIX ETF.
Oh,
so talking about Ford's Chariot fleet service. Through Stratum's, this I'm quoting, here from a TechCrunch article. Through Stratum's vendor marketplace, for example, Ford can request gas fill-ups for its Chariot shuttles. The next day, a fuel company will come to fill up the tanks and then send that information back into the system. And here's where we get to the next knock-on effect, and it has to do with gas. When your car is a part of your life, it's like, you paint your house, you walk your dog, you fill up your car, it's part of your life. Once the transportation, you're getting that delivered as a discrete service, you're no longer gonna do everything. You're no longer gonna take to fill up the tank. So gas stations could actually end up getting disrupted in a major way.
Wait, so where would people fill? Oh, so people just won't need to do it. Well, we also have the electric cars coming on board.
That is actually a bigger thing. That's a real existential threat for gas stations in the longer term. But this mobility as a service thing, what we're seeing crop up is these companies like Stratum are basically going to help get gas to the cars and provide gas as a service rather than people taking their cars to the station to get it.
Oh,
the tank
wonderful!
filled.
So I wouldn't even have to drive my car anywhere. It would get filled up.
Yeah, exactly.
Huh.
And so I'm quoting here from a 2017 Wall Street Journal article about the future of gas stations. Some big oil companies are testing services that bypass the gas station altogether and deliver fuel directly to consumers. We're looking at ways that a shift by consumers to car sharing or autonomous vehicles could create opportunities for oil companies to operate car fleets.
I just figured out the knock-on effect.
I know. I think
it's all coming together now. But keep going.
Don't give it away for the slow viewers.
Okay.
I love you. But it's actually kind of funny that, first of all, that oil companies are like, cars, they're a thing you put oil in. We have a big advantage in running these fleet sharing services. It's a little ridiculous. But the point is that gas stations will become a less prominent part of people's lives. And what do people buy at these little gas stations?
Mega Millions.
Yeah, that's right. I'm a little bit on a limb here. Not a lot of good numbers on lottery ticket sales. However, whenever there's a list of the places in a state that sell the most lottery tickets, gas stations are always near the top of that list. And actually in 5 states, including California, you can buy lottery tickets as you buy gas. It's called Play at the Pump. And as you put in your debit card for gas, they'll say, would you also like a lottery ticket?
Wow. Wait, and so can you play on the screen, or it actually gives you...
You can play on the screen. Well, you'll play... I think it spits out a ticket, but you choose your numbers on the screen.
Oh, crazy.
Which is a little messed up. So, are you satisfied? Did I get you from here to there without using a car?
Yeah. I mean, so... I know a lot of people that get their lottery tickets at the grocery store or at the corner store is the more popular one. Get some donuts and a scratch off.
Yeah, I mean, we can put the lottery tickets is really just a little bit of fun, but
the bigger picture is...
The bigger picture is that transportation is changing, and higher rates on the margins again might influence, it might speed up, accelerate, if you will, this change.
Yeah, absolutely. I mean, like we know with technology, there's going to be a lot of changes no matter what. I mean, so this is electric vehicles, this is ride sharing, this is automatic driving and all sorts of things. But then on top of that, it's raising rates has actually a much nearer impact on the auto market.
Exactly.
And so that's why, I mean, you see a lot of these major car companies invest because people are not going to be buying as many cars. These major car companies are investing in Lyft, in Uber. They want to get a part of the software as a service aspect of this as well. So it's sort of like Detroit has to be Detroit 2.0 and figure out a new way to operate in the future.
Let's hope for Detroit's sake, but we'll see. Roger, what do you think the future holds for the car industry?
I think one of the big knock-on effects is going to be for local authorities here in the UK or local governments or whatever, because how many people have been used to supplementing their income with money from parking fines, speeding fines, etc. Now that's reliant on us, the idiots.
And lottery tickets.
The idiots driving the cars. Whereas if you've got smart cars, presumably they're going to drive within the speed limit. They're not going to get parking tickets. So where are these governments going to get the supplementary income from? They're going to have to start charging pedestrians or whatever. So I think you're going to have to see some new ways and inventive ways from local authorities to raise that money that they're going to lose out by smart cars not breaking the laws the way that we do.
So I think that does it for the
knock-on effect. But I first want to ask, do you play any of these scratch-offs?
No,
is this the first time you've bought any of these?
No, I mean, I buy the Mega Millions when it's ridiculously huge. And
oh, you do?
Like,
oh, you fall. I just have to make a statement. Playing the lottery is one of the dumbest things you could do. Unless you have like a strategy. There is a really wonderful piece about someone who had a strategy, a statistician, and he was able to play the lottery and
because
win it.
You can see on the outside of the ticket, sometimes there's a clue about whether it is a winner or not.
Oh.
So there actually appear to be hedge funds that are buying tickets en masse.
Okay, but otherwise, if you're wasting your money on this...
Yeah, I mean...
You are wasting your money on this.
I have a lot of views on this. Like you know, maybe $2, the marginal value of several $1 million is actually higher than the cost of the... we're going to go down a bad rabbit hole here. So I'm going to toss it over to Roger, who will kick it into perhaps an even higher gear for our new segment. We have another new segment called Curiouser and Curiouser. Roger, over to you.
So this is all about short interest and what we've just seen in the price action of Tesla, which has risen about 23% in 9 days. And it reminded me of something that happened to Volkswagen back in 2009. Now, back in 2008, 2009, we saw that Volkswagen rose incredibly in the market during a period of an incredible financial bust. So in October 2008, just after the Lehman crisis, there was this incredible move that we'd never seen before on Volkswagen. And it was all to do with short interest, how much people were short the stock. Now, people were short about 12%. This was hedge funds and the like. And everyone thought that Porsche and Lower Saxony, which is the area of Germany in which the headquarters are, they owned about 50% of the voting shares. It turned out over the weekend of the 25th, 26th of October, that Porsche announced that it owned around about 74% of the voting shares. Lower Saxony owned 20%, and yet the market was 12% short when there was only 6% out there. And this set off a chain reaction of short covering, the like of which I haven't seen in 25 years of covering markets. The stock closed on the 24th, Friday at 210. On Monday, it reached over 600 euros. But that wasn't the end of it. On the Tuesday, the stock soared to nearly 1,000 euros, a quintupling of its price in only 2 days. And this is in the midst of an incredible equity market bust. So it shows that you can have negative news, but that doesn't mean the stock's going down if there is a sufficient short interest. If you look at Tesla today, it's got around about 30% short interest. And to compare that to something in the market such as Netflix at 4.6 or Procter & Gamble at 1.15%, it's quite a large short interest. Now, MyMedics is near 50%, so it's not a record. But the point here is that even if the news is bearish, if you get the wrong sort of catalyst, you can set up a chain reaction if there is sufficient short interest. So anyone out there who's going short stocks should take a close look at the size of the short interest and not be caught out as we were in that remarkable time in 2008 when Volkswagen went from 200 to 1,000 euros in 3 days.
Yeah, what do you do if you're short a stock and it goes from 200 to 1,000? Are you just lose your shirt? You're out of... I guess there's so many margin calls that I don't even know what you do.
That's exactly it. Those hedge funds went out of business. People lost their jobs. It was a terrible time. I mean, for briefly, Volkswagen was the largest company in the world by market cap.
So right now, Tesla shorts are about 30%. Is that what we said?
Yeah, according to Bloomberg. I mean, I'm always a little bit dubious because these figures update quite slowly. But all we can say is there is a significant short on Tesla compared to the sort of average in the market.
It's interesting because Elon Musk recently said that Tesla shorts were going to see some problems in the next 3 weeks. He specifically said 3 weeks, which is when the quarter ends. That's important, and that's when their numbers come out. I will give him some credibility. He did say, I think it was a few years ago, that Tesla shorts were going to see a tsunami of hurt. And the stock surged over 500% the next year.
Yeah.
So not that it's deserved or not whatever, but if you are going short, you do have to be careful. You should know what you're doing.
Yeah, I mean, there's a lot of ways in which the stock is kind of a disaster, which we don't necessarily have to get into, but and it's a fascinating stock story because heavy sentiment on both sides. But, you know, here's the thing. When you buy a stock, like, let's just really go back to basics, back to the buttonwood tree where the stock market was created. Okay. If you're buying a stock, I'm giving you money to do something with.
Great.
Like, there's an economic function behind buying a stock. That's why we have markets.
Sure.
If I'm shorting a stock, there's no economic function behind it. I'm just basically making a bet against a whole lot of other people. And so that's why the shorts have to be so much more careful about market dynamics, because you're basically just gambling. And it's like...
It does send important market signals, though. I mean, short
sure,
sellers play an important role in the markets.
Sure, and I'm not disputing that.
In terms of setting prices.
But it's nicer if you don't like a stock to just not include it and hope it's in your benchmark. I mean, if you're actually shorting a stock, nothing wrong with it. Maybe you're sending good economic signal, but you're not actually doing anything economic.
Arguably, it is part of the price discovery, though.
Yeah, sure. No, it's otherwise, you know, other stocks could become crazily overvalued, and that's important. I'm not saying we shouldn't allow it. I'm just saying...
I do think that the Volkswagen example is a very key thing to watch, especially as we go into the next 3 weeks. Who knows what
it's almost like it is, and because the stock can go up forever, as everyone knows. It's almost like if I'm selling you a lottery ticket, I'm saying, you know, I'm likely to win $2 because you're probably not going to win anything.
Yes.
But what? So now I'm going to have to pay you many millions of dollars because there's unlimited upside.
Right, but if you collect it from enough people, you'll come out okay.
Unless you don't. You know, well, all it takes is this 1 mega millions to hit. By the way, if we're not back next week, it's not because we won this. It's just because we're not back. I think that does it for this week's episode. Thank you for joining us. Thank you, Justine and Roger. And I think we're all thanking each other. I don't know why I'm thanking you. But thanks for joining us. This has been The Knock-On Effect, where a new episode comes every Thursday on Real Vision. And we also do a podcast version on your podcast app under Real Vision Presents.
And we go into a little bit more depth there, so it's a little bit of a longer format, so you should check that out as well. And if you want more on the markets and the economy, make sure to check out realvision.com/knockoneffect, where you can sign up for your 14-day free trial.
Yeah, and watch those the thesis about the car market.
Max Wolf videos, yeah.
And a whole host of...
Have fun. Indulge.
Go crazy.
Okay, see you guys next week. Can we scratch these now?
I guess.
I don't know how to play them.